7 criteria: quality, valuation, and size. We backtested quality at reasonable price, or QARP, on U.S. stocks from 2000 to 2025. The portfolio delivered a compound annual growth rate of 10.42%. The S&P 500 returned 7.8% over the same period. But the real finding is not the returns, it is the drawdown protection. QARP gained plus 14.6% cumulative during the dot-com bust, while the index lost negative 34.9%. The universe is all U.S. stocks with positive earnings and a market cap above $1 billion. All 7 QARP criteria are applied simultaneously: return on equity above 15%, debt to equity between 0 and 0.5, current ratio above 1.5, income quality above 1 meaning operating cash flow exceeds net income, Piotrowski score of 7 or higher, price to earnings between 5 and 25, and market cap above $1 billion. Rebalancing is semi-annual in January and July. Semi-annual frequency balances responsiveness with costs. Annual rebalancing might miss quality deterioration mid-year. Quarterly adds costs without much benefit for fundamental factors that change slowly. Transaction costs are not included in the published results for comparability with academic literature, but with semi-annual rebalancing and 30 to 50 large cap stocks, cost drag is approximately 0.2 to 0.4% annually. If fewer than 10 stocks qualify, the strategy holds cash in the remaining allocation. Over 51 semi-annual periods, the cash rule never triggered. The average qualifying count was 44.3 stocks per period, which means the screen is selective but not extreme. We start in 2000 because the Piotrowski score requires 2 consecutive annual reports to compute year-over-year changes, and financial statement data gets less reliable before that. The benchmark is the S&P 500 Total Return Index because that is what most passive investors actually hold. QARP reverse engineers Buffett criteria into a systematic screen. Most strategies use 1 or 2 factors. Magic Formula combines value and quality. Piotrowski uses quality within value. QARP uses 7 criteria simultaneously, making it one of the most selective screens you can build. The academic basis is strong. Novi Marx showed in 2013 that combining quality and value produces robust excess returns. Asnes and colleagues demonstrated in 2019 that the quality factor alone generates meaningful alpha. QARP layers both dimensions together. The combination avoids 2 failure modes. Value traps are cheap stocks that are quietly deteriorating. They will not pass the return on equity, Piotrowski, or income quality tests. Quality traps are great businesses at terrible entry prices. A fantastic company trading at P to E 40 does not make the cut. Each dimension covers the blind spots of the other. With 7 simultaneous criteria, the selectivity is extreme. Each holding must clear a high bar on profitability, leverage, liquidity, cash flow quality, fundamental momentum, valuation, and size. That concentration is a feature. When every position has passed 7 independent tests, the portfolio naturally self-selects for resilient businesses. Here are the numbers from 25 years and 51 semi-annual rebalancing periods. The 49% annual win rate sounds bad. The strategy trails SPY the S&P 500 ETF in roughly half of individual years. But that number is misleading on its own. QARP does not win by beating the market every year. It wins by protecting capital during the years that matter most for long-term compounding. The years you lose least are the years that contribute most to your final balance. The drawdown protection is the strongest part of the story. During every major downturn except COVID, the portfolio outperformed. The dot-com bust was the purest demonstration. The market was loaded with speculative tech names, no earnings, no cash flow, sky-high valuations. The QARP screen excluded all of them. Every single filter, return on equity, P to E, income quality, and Piotrowski, would have rejected those stocks. So while the S&P 500 lost a third of its value over 3 years, the QARP portfolio gained 14.6% in profitable, low-debt businesses that nobody was writing about. The 2008 financial crisis was different. This time, the crash was driven by leverage and credit risk. Banks, home builders, and financial companies collapsed. QARP's debt-to-equity filter kept most of them out. The screen still fell 23.9% because nobody escapes a systemic crisis completely. But that's over 10 points better than the index. And smaller drawdowns mean faster recovery because you have less ground to make up. COVID in 2020 was the one exception. QARP returned plus 11.8% versus SPY's plus 15.6%, trailing by 3.8 points. The recovery was driven by tech stocks with high valuations that the P/E filter excluded. That's the trade-off built into the strategy. And the gap was small. The 2022 bear market returned to form. Rising rates punished speculation and growth stocks. Companies with strong fundamentals and reasonable valuations held up better. The screen returned negative 12.3% versus negative 19.0% for the index, providing 6.7 percentage points of protection. The volatility at 16.8% is marginally higher than SPY's 15.3%. But the Sharpe ratio of 0.50 versus 0.38 shows you're earning more per unit of risk, and the math of recovery matters. To recover from a 27.1% loss, you need a 37.2% gain. To recover from a 38.0% loss, you need a 61.3% gain. That's a meaningfully harder climb, and over multiple drawdowns across 25 years, those recovery differences compound into real outperformance. QARP thrives during market stress. When over-leveraged and overvalued companies get punished, low-debt, high-quality businesses hold up. The dot-com period and the 2022 bear market both demonstrated this pattern. The screen systematically excludes the stocks most vulnerable to valuation-driven and leverage-driven crashes. It lags during momentum-driven rallies. During extended growth periods, the P/E cap of 25 systematically filters out the strongest performing names. A company trading at P/E 35 might be the best business in the index, but QARP will not own it. The strategy is naturally defensive. Combining it with a momentum or growth strategy creates all-weather coverage. The practical implementation is straightforward. Run the screen semi-annually in January and July. Buy the full list of qualifying stocks. Accept concentrated portfolios when fewer stocks pass. Hold cash when nothing qualifies, because the market is expensive and the screen is self-regulating. Do not loosen the filters in bull markets. The temptation to raise P/E to 30 or drop the debt-to-equity requirement is strongest exactly when the filters protect you most. The variable portfolio size is a feature, not a bug. During expensive markets, fewer stocks qualify. The screen naturally becomes more selective, increasing cash allocation when valuations are stretched. During cheap markets, more stocks qualify, increasing equity exposure when opportunities are plentiful. The screen adjusts itself to the environment without any manual intervention. Piotrowski Signal 7, the share dilution check, uses total stockholder equity as a proxy since shares outstanding is not reliably available historically. Equity can increase from retained earnings, which is good, or from new issuance, which is bad. It is an imperfect proxy that we document transparently. The screen does not balance sectors. Some periods concentrate heavily in a single industry, creating unintended sector bets on top of the quality and value bets. If financials happen to dominate the qualifying list one year, you are making a sector bet whether you intended to or not. Very few stocks pass all 7 criteria simultaneously. The average of 44.3 per period is reasonable, but periods with fewer qualifying stocks carry higher single stock risk. All metrics use trailing data, so competitive disruption and management quality aren't captured. A company passing all 7 screens today might face a structural challenge that backward-looking data can't see, and the 49% win rate means patience is required. You'll trail the market in more years than you beat it, and the alpha shows up in bursts during downturns. If you can't stomach underperforming for 2 or 3 consecutive years, this strategy will test your discipline. That's what the data shows across 25 years and 51 semi-annual periods. Full results, charts, and the backtest code are on the blog. Link in the description. Run the QARP screen yourself on CetaResearch.com. Adjust the filters, change the thresholds, and see what qualifies today. All metrics are pre-calculated. Subscribe for more backtested strategies every week.